one more small correction, and all things being equal, my belief is we will restart the bull count or bullish cycle will run again. If you recall back in 2011 when gold ran virtually from, depending on where you go back to, 700 or 1,000 to 1,900, it went through either 2 or 3, I believe it was 2 full bull counts. In other words, 1 through 5 ABC, 1 through 5 ABC. So it ran through it twice. There's no reason to assume that gold will not return to a full bullish count after this correction is over.
The World Gold Council recently published a report that stated that it expects gold prices to rise an average of 5% annually through 2040. With Treasury bond interest rates falling below 5% and recession fears on the rise, the World Gold Council's report has attracted significant attention. But is their forecast truly achievable? Market expert Gary Wagner particularly discusses the recent drop in gold prices and the outlook for the price. Looking at gold's trajectory, Gary explains that gold's recent rise from $1,960 to $2,800 mirrors the 2011 peak, but with more global pressures today, such as geopolitical tensions and economic instability. Drawing an analogy to 2011, Wagner points out that after the dollar's RSY dropped below 30, gold continued to rally before making a clear top. Similarly, in the current market, gold experienced a similar pattern, rising after the RSI drop, then reaching its peak before entering a corrective phase. These factors suggest that the ongoing global instability will likely support a continued gold rally once the current pullback ends, much like it did in 2011. Based on fundamentals, Gary predicts that gold's recent peak of $2,800, a record high, may not be surpassed this year but could be exceeded in 2025. He expects gold's current correction to be less steep than the 2011 decline. Since 2010, gold has had 9 years in which it has gained in value and 6 in which it has lost value. Its 3 biggest years of growth before this year were 2010, 2019, and 2020, in which it gained 29.71%, 18.3%, and 25.14% respectively. Its 3 biggest losses were in 2013, 2015, and 21, in which it lost 28.04%, 10.52%, and 4.39%, respectively. Now, we present the clips of Gary Wagner's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
The key is technicals are only as good as the fundamental fabric that's in play at the moment. And if we look at the long-term move in gold, the real bottom occurred at about $1,960 back in October of last year, and it moved from $1,900 to $2,800, a $900 move. That's a superior move. I mean, that's the same kind of move we saw in 2011. However, in 2011, we actually had a long procrastinated price decline. In fact, for the first year after it hit 1900, it oscillated between 1900 and 1800. And then when it broke, I believe it was 1564 in the charts, it virtually crashed over a multi-year period down to just above 1,000, 1,020. I think in the case of current pricing, we have more than just a economic recession or a banking crisis or Federal Reserve intervention, because the geopolitics and the conflicts were not as intense. So we are working with more variables that have propelled gold higher that I believe will continue to move gold higher from this point after the correction has concluded. I believe that the highs that came in at the end of October at $2,800 were in fact the peak. It's the highest value on record. I believe that that will not be taken out this year. We only have 2 more months left, but more likely next year. I think that in terms of my forecasts, I had to update them a couple of times, because at first I was looking at about 2,700, and as more fundamental variables came in, we had to modify our model to really fit the fundamental fabric that we were looking at. So I was looking for different waves to be extended, and I was looking at the higher end of the spectrum. My personal sentiment is $2,800 is the target that we hit for the high of this year, will remain that, but I don't think we will enter a multi-year correction as we did at the end of 2011. I think we'll have a much shorter correction in terms of steepness. I think it will be more shallow. So far, we have corrected about 46% of the price move from 2350, let's call it, the beginning of this last impulse phase, waves 1 through 5. We've concluded that we are well into the corrective phase, and I believe that in terms of price decline, while we could see it go below 2,600, I think that at least for now, we'll see at minimum a counter wave up, and from the counter wave up, one last move down, and that will occur in Q1, and then return to a bullish count. And it will be during that bullish count that we take out $2,800 next year. In other words, to simplify it, I think there will be a key difference between what we saw in the middle of 2011, what we're witnessing now, in that once gold hit 1900, that was pretty much etched as the highest point that gold would reach until this period in time, many years later, in which it began to move back in October when gold was sitting much lower. That would be here at 1957. So when we consider that in the short span of about a year, October to October, we've seen gold move from 1900, the old all-time record high, to 2800, the new all-time record high. And most importantly, I think that we are in a correction. That's obvious, and we've gone down 200, but I don't think the end of the long-term bullish market sentiment.
With Trump's clear victory, U.S. equities and cryptocurrencies surged while reducing gold appeal. In assessing gold's outlook, Gary emphasizes that the Federal Reserve's next steps on interest rates are crucial. Following a large rate cut and an expected reduction in December, the Fed is working toward normalizing rates in the 3 to 3.5% range. Continued cuts support gold prices, while a rate pause may alter market dynamics. The non-yielding yellow metal benefits from a low interest rate regime, and historically, gold has risen during periods of rate cuts. Over the last 2 decades, gold has consistently delivered positive returns during periods of interest rate cuts. The HDFC securities analyst said that between 2008 and 2011, when the stance turned ultra-dovish to combat the economic slowdown, gold prices skyrocketed by 152%. While the Fed's upcoming rate cuts may not immediately impact gold's price trajectory, many analysts believe that there is still room for gold prices to rise further in the coming months. Goldman Sachs's analysts, for example, expect a target gold price of $2,700 per troy ounce for early 2025, while other experts expect even bigger price increases for gold in the coming months. Let's get back to the interview.
Certainly, the fact that Trump won is a decisive factor in what we're seeing in U.S. equities. Those have moved higher. Cryptocurrencies out of control to the upside because he is an advocate, and gold, oddly enough, moving lower. My best explanation for why we've seen gold drop $200 from the all-time record high at $2,802 down to current pricing at around $2,600 is the last leg of the upside move rally in gold that took gold from about 2640, 27 up to the all-time record high was largely based on the uncertainty of the outcome of a presidential election, and most importantly, whether or not we would get a decisive victor, meaning an uncontested result. Had the other candidate won and Trump chose to say that that was unfair or something, that would have really fueled gold to higher pricing. But the fact that Trump won, there was certainty in that. There was a peaceful transfer of power. The uncertainty factor that was baked into the price of gold diminished, came out, and that's why we've seen gold correct by $200. I have to pose, without having a direct answer, is that what we need to see is the action of the Federal Reserve. Now, they have cut rates, a jumbo rate cut a little while ago, a 0.25% rate cut in November. It is anticipated that the Fed will cut by another 0.25% at the December FOMC meeting. And most importantly, what they are focused on in terms of their dual mandate is to right now normalize interest rates. In other words, take them between 3% and 3.5%. So there's a ways to go. If they continue to cut rates, that's going to be bullish for gold. If rates are maintained at the current level, if they pause, that would change the dynamics to what I believe is going to happen, which is that the Federal Reserve will continue to cut interest rates as they normalize them to between 3% and 3.5%.
Gold has seen significant fluctuations in the past decade, reflecting its role as a hedge against inflation and a safe haven asset. The price chart reveals notable spikes during economic uncertainty and geopolitical tension, while periods of stability were marked by stronger currencies and improving economic conditions. Given the ongoing global instability, do you believe gold will maintain its upward momentum and reach new highs in the next few years? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.